What's up, guys? I was a bit surprised to see that in this month's survey, where you guys, the viewers, get to choose what topic I cover next, that the different investing strategies compared growth versus income versus dividend growth was the clear winner. I thought for sure the market crash one or the safety ETFs would win, but hey, I was wrong. But I'm glad that I get to cover whatever topic you guys want to see. So in this video, I will compare the three different investing strategies in my own words and based on my personal opinion. So we'll go over the three and the pros and cons for each one. So I just want to make it clear that what I'm telling you is based on how I see things. It might not be exactly the exact definition of how these strategies are defined. The longer I go through my investing journey, the more I realize that investing is not black and white. And the most important thing to find is really to find the investing strategy that best suits your needs and your objectives, and not just follow what everyone else is doing, myself included. So what is the difference between the growth style of investing versus the income style? And what about the dividend style or dividend growth style? Where does that one come in? And what are the pros and cons for each one? So another thing, once you actually choose your style, decide which one is best for you, how do you build a portfolio tailored to that style? How do you get started? Let's get to it. A lot to cover in this video. All right, so first, let's talk about the most popular and most mainstream style out there. The one I would say that gets the most attention in the news, in the media, whatever, the growth strategy. So just like the word says and means, the primary objective of this strategy is to grow your capital or to grow your money, basically your net worth. So how do you invest for growth? Well, there are two main strategies out there. Index investing, which is very popular nowadays thanks to Jack Bogle, may rest in peace, the founder of Vanguard. And the second way, which is what Warren Buffett does. So it's really the old school original way to invest in the stock market, stock picking, right? So I'll focus on index investing right now because that's what's really mainstream and easier for the everyday person to do. And in my opinion, it makes the most sense. Stock picking is actually pretty hard because you really have to know how to analyze businesses, how to analyze stocks. And most people, including myself, don't know how to do that, don't care about doing that, don't have the time to do that. So even Warren Buffett actually advises the everyday person just to invest in the index funds like the Vanguard funds, even though he's a stock picker. So that says a lot, right? So most people just buy the classic index funds nowadays, which is basically like casting a big net over the ocean being the overall world economy or the overall stock market. So it's like buying the entire stock market, right? That's how they usually say it. So you buy a couple of broad-based index funds to really get exposure in everything, and your money will simply follow whatever the overall stock market is doing. And historically, the stock market just keeps going up and up. So people consider this a very sound and logical strategy because most people do expect it to keep going up. Of course, there are bumps along the road. We call that stock market crashes or stock market corrections. But in the really, really long scope of things, the stock market goes up. So for those of you who don't know what an index is, I'll explain it to you real quick. An index fund or an index ETF is a portfolio of stocks based on or designed to replicate a stock market index. So I know that doesn't really say much, but giving you the example really makes more sense. So the most popular one of all time is really the S&P 500 index, which basically measures the 500 biggest publicly listed corporations in the US. So whether you own VOO or VFV from Vanguard or the SPY ETF or even XYLD from Global X, they are all these funds or all these ETFs are based on the same index, the S&P 500 index. Many funds are. So the exposure that you have, the stock exposure that you have with all these funds are pretty much identical. Now, it's important to understand that with an index-based ETF, your exposure to each stock within the index depends on how big the value of the company is. The bigger the company is, or the bigger the company is worth, the bigger percentage you will have of that company. So the biggest exposure right now in the S&P 500, for example, is Apple, because that's the biggest company in terms of value from those 500 companies. So what are the pros of the growth strategy? What are the advantages? Well, number one, it's very easy to do. This is because all you need is like 5 to 10 funds at the most to really get exposure to the entire world economy, or even less than that. For example, if you're Canadian like me, all you need is a fund that covers Canada, one for the US, one for emerging markets, and one for developed economies outside of North America, things like Australia, Japan, or Europe, of course. And that's about it. You can maybe add one fund that covers real estate or something else you want specific exposure to, but that's about it. So I personally, I can't see how you would need more than 10 funds to really have a really broad-based portfolio to accomplish the growth style. So no need for stock picking. Very, very easy to do. Everyone could do it. And this is basically the index fund route. Number two, pro number two, it really is a proven long-term strategy that works. So like I mentioned before, it's very well known that long-term, over the really long period of time, it's a well-proven and very smart strategy, since the stock market is basically a representation of the world economy and the best businesses in the world. Everyone fully expects the revenues and the profits of these companies to go up. And there's a reason, why the expression money makes the world go round exists. It's because it's true in a sense, right? Capitalism, democracy have made corporations very, very powerful entities. It's not, the king of England or the queen of England anymore. So being part owner of these corporations, of these powerful entities, is really a no-brainer. And that's what investing in the stock market is. You're really investing in a tiny, tiny piece of these corporations. And if anyone tells you otherwise, I would probably never listen to them again. Pro number three, these index funds have very low fees, and they're also very liquid. They're super liquid. So index funds, passive index funds that cover overall broad-based market, stock market, really have some of the lowest management fees of all time that I've ever seen. And thanks to capitalism, thanks to competition, they just keep getting lower. So I've seen some with 0.03, 0.04%. I mean, they are practically nothing nowadays. Vanguard is very famous, very popular for having the lowest fees and most liquid funds out there. So when you hear liquid, when I say liquid, it basically means that it's very easy and quick to sell and even buy shares to take some money out of these funds if ever you need some cash. So this is because these funds are very popular and there's a lot of trading volume every day on them. So it's very easy to redeem and to buy as well. So it's basically instant when you buy or sell. So what are the cons now of the growth strategy? What are the disadvantages? Well, number one, you're basically at the mercy of the stock market. So there's really only one way to make money with this strategy, guys, really to sell your shares at a higher price than the price you bought them for originally, right? That's it. There's no ifs or buts about it, guys. You are at the complete mercy of what the stock market does. So during crashes or corrections, when your investment, or your account value drops significantly in value, although temporarily, you will feel very uneasy, very anxious, but this also depends on your experience level, of course. The reason is pretty simple. It's because the only way you make your returns, or the only way you make your money, is with capital appreciation. So when stock prices tank and your account value goes down, there is no reprieve. So this is what I mean when I say that you're at the complete mercy of the stock market. Con number two, very low yield, very low passive income. So because you're buying the entire stock market, you are buying, yes, many dividend stocks, because dividend stocks are part of the stock market, obviously, but you're getting a lot more stocks that don't provide a dividend in comparison. So this is why these types of broad-based index funds usually have very low yield. So the S&P 500, for example, has about 1.5% yield, and the NASDAQ index even less, because many of the companies inside the NASDAQ are tech companies that typically don't give a dividend. So if it's passive, consistent passive income that you're looking for, the growth strategy is definitely not the strategy for you. This is why growth investors typically just reinvest all their dividends, even though they're very small. They typically reinvest them via the drip automatically to further increase their capital gains long term. So no income, which means you basically cannot quit your day job. Con number 3 is that you will have some agonizing future decisions to make. When do you sell? And what next? So many newer investors don't realize this, and this could be a source of anxiety and contention later on. So trust me, after doing over 120 consultations with many growth investors, this could be a big issue and is a big issue. So the only way to realize your capital gains, whether it's in 10 years, 20 years, is you actually need to sell your shares. If you don't, any gains you see in your investment account is fantasy. It's just on paper and not a reality. So this is why they are called unrealized gains. I show you guys this every month. Every time I unveil my portfolio and show you my broker account, right? It always says unrealized gains or losses. Unreal is actually in the word, guys. So if you're up 35% overall, let's say, that's amazing. But in the next couple of weeks or months, let's say the market crashes and it goes down 35%, well, you're back at square one, right? You're back at original. So the $1 million question as a growth investor is, when should you sell? How much is enough for you to actually pull the trigger? What if you sell everything and the stock market just keeps going up and up and up? What if you sell during a bad market cycle because you just retired that year and you need the money now? So one downside of being a growth investor is all the mind games you will have to play with yourself later on. So I like to call it the what if game. And trust me, it's not a fun game. I played it a lot with myself. It's very time consuming, can be a source of stress and contention. So also, let's say you turned $1 million into $2 million in 10 years and you sold all your shares. That's amazing. You made a $1 million capital gain. Great job. But now what? What do you actually do with this $2 million in cash? Do you reinvest it somewhere else? So there are additional steps later on that growth investors need to make, and these decisions can be pretty daunting for everyday people. All right, so moving on to income investing or income focused investing now, the investing strategy I personally use and talk about on this YouTube channel, as many of you well know. So for me, the primary objective of the income strategy is to maximize your income, your passive income. So unlike the growth strategy where it's all about numbers, the income investor doesn't really care that much about numbers or overall total returns. What I really care about is increasing my passive income every single month. The more passive income I have, the more disposable income I have, and thus enhancing my quality of life more and more and more. So this strategy, you're really trying to maximize your income, not your capital growth. How do you do that? Well, by investing in funds that use income enhancing strategies and funds that typically hold predominantly dividend stocks. So the goal is really to maximize the passive income you get every month with the intention of becoming financially independent. So if your monthly expenses are about $4,000 a month and you make $4,000 of passive income every month from your investments, congratulations, you've achieved financial independence and no longer need to rely on a day job for income anymore. So what are the pros of this strategy? Let's go through them one by one. So number one, you are much less dependent on the stock market. So a key aspect of the income strategy, in my opinion, is that you have no intention to really sell any shares, right? You simply don't need to, because your primary source of return is actually coming from the passive income that your portfolio generates, not the capital appreciation that your portfolio is generating. So the income investor is much less dependent on what the overall stock market does. Up, down, flat, sideways, doesn't matter. As long as the income keeps coming in, it's all good. And because most of the income is actually coming from income enhancing strategies like covered call writing and leverage, which is infinite, and actually very lucrative and resilient during stock market crashes. You really don't care that much either about stock market volatility. You welcome it. So if you're newer to my channel and have no idea what covered calls are, make sure to check out my other videos on that topic. I even have a specific YouTube playlist for the covered call video. So in short, the covered call strategy, or a fund that uses the covered call strategy, is really a zero risk income enhancing strategy where you are dampening or giving up some share price upside, some capital appreciation in your portfolio for more income, for more money now, more passive income. Pro number two, advantage number two, consistency and predictability. So since you are making your returns with your income, it's very easy to predict your returns, right? So for me, my return, or my overall return, whatever you want to call it, for the year is simply my overall dividend yield. So if you have no intention of selling any of your share, guys, then whatever passive income you make via your dividends and distributions is your return, right? So if you make a 10% yield like I do and never touch the principal, your return is 10% a year, as simple as that. Another cool thing is that since you are making your money primarily with covered calls and not dividends, dividends are obviously part of it, you're not really that worried about dividend cuts either. So blue chip companies, which are, big corporations, the leaders in their respective fields, very rarely cut their dividends. I said rarely, not never, but it's a very small concern because income investors typically hold funds and not single stocks anyways. So stock pickers are definitely the ones most at risk if dividends get cut, but they rarely do on blue chip stocks anyways. Advantage number three, hands-off passive income, or money now. So this strategy is completely hands-off because, like I mentioned earlier, you live off your interest, off your income. So there is no need to decide when to sell your shares. The income is completely passive as well. It gets deposited in your investing account every single month or every single quarter. And the only thing you need to do is really move the cash to your bank account, which takes about 6 seconds with a few clicks. Beautiful. Also, the fact that you're getting your money now rather than later on is also a wonderful thing. Passive income enhances your quality of life now instead of later. So think about it. How much better would your life be if you were making $500 a month without lifting a finger, in addition to whatever your salary is or whatnot? What about $1,000 a month? Or $5,000 a month. So it could definitely make your life and things a lot easier for you. You could trust me on that 100% because I'm actually living it. Number four, tax efficient passive income. So many of the funds I own are very tax efficient. I'm talking about the income here that they generate. Of course, if you have any income coming in from your TFSA account, your tax-free savings account, it's all tax-free, but I'm really talking about a regular cash account here. So funds that use a covered call strategy, the income from those are much more tax efficient than regular dividend income that come from single dividend stocks or really dividend ETFs that don't use the covered call strategy. So this is really because the income from these funds are a combination of various classifications of income. So there's really four main classifications of income here in Canada. There's interest, which is the worst, eligible dividends, which is a bit better, capital gains, which is even better than dividends, and then there's return of capital, which is the best because it's not taxed at all. So covered call income, guys, is actually capital gain income, not dividend income, which is taxed better than dividends. And then there's return of capital, which is not taxed at all. So I won't go into further detail about all the tax implications in this video, but if you want to learn more about these four classifications of income, I actually have 2 tax videos on my channel, which I strongly suggest you check out. Check out my YouTube playlist. There's one playlist for those 2 tax videos, so very easy to find. In short, guys, the income that comes from these funds, these types of income enhancing funds, are very tax efficient, more so than eligible dividends, and definitely more than interest income, which is what you get from fixed income, things like government bonds, corporate bonds. So those that's really the worst of all time. Number five, this is a very flexible strategy because you could turn it into a growth strategy with the snap of the finger. So what do I mean by that? Well, another cool advantage of the income strategy, guys, is that if you really like the concept, but you don't really need the passive income right now, let's say because you're still working and have a great salary or whatever, you could simply turn the income strategy to a growth strategy instantly by turning on the DRIP. So if you didn't know, the DRIP stands for Dividend Reinvestment Plan. So instead of getting all your passive income, all your dividends and distributions in cash, your broker, whoever broker you're with, will buy you more shares of the corresponding fund instead, free of charge. So this will cause a compounding effect, thus transforming your income strategy to a growth machine, as your dividends or distributions are automatically being reinvested for you automatically every month. So if you like the consistency of the income strategy, but your objective is really growth for the time being, turn on the DRIP, guys. And then you will, instead of later on, let's say if ever you want to stop the compounding effect, let's say you want, okay, I'm ready now to start getting the income in cash. All you need to do is simply turn off the DRIP with one click or one phone call to your broker. So it's as simple and easy as that. So many of the clients that I talk to via my consultation service are people who are at the height of their career, and their height of their salaries as well. So people like doctors, IT professionals, engineers, etc. They love the fact that the income strategy is hands off. They love the fact that they're consistently making 8, 9, or 10% a year. They know exactly what they're making. And they love the fact that they don't have to watch or care about what the overall stock market is doing. So they basically turn on the DRIP, set it and forget it. So the DRIP does all the compounding and the growth work for them. So they could focus on their career instead, being at peace knowing that their money is growing at whatever their annual dividend yield is, right? So now let's get into the cons. Believe it or not, there are cons with the income strategy. So con number one, this should be the most obvious one. You do have limited capital growth. So the income investor will never beat the growth investor in terms of capital appreciation or net worth appreciation over time. The chance is pretty much zero. Since you're making your returns with the income, it's only normal that your capital growth is lower, right? You can't have the best of both worlds. Now, I'm not saying that your capital will never grow. Your capital will still grow and follow what the overall stock market does, because we basically hold the same stocks as the other investors, as a growth investor, but we'll never have the same capital growth. So this is simply because of how the covered call strategy works. You are sacrificing potential share price upside for more income right now. Con number two, disadvantage number two, higher fees. So one thing that us income investors can't really get away from is that the funds we invest in have higher management fees than the index funds or the broad-based passive index funds I spoke about earlier, which is what the growth investor invests in, right? So this is simply because it takes more work for the fund manager to manage all these income enhancing strategies like leverage and the covered calls, primarily the covered calls. So it takes time for them to actually sell the covered calls every month. And a lot of these funds are leveraged, so they borrow money to boost the yield, which means you got to pay for that, right? This comes with higher fees. So when they borrow money, they also pay interest. Think of it like investing with margin. So it's pretty much the same thing, but the fund manager is taking care of all that instead of us borrowing money to invest in more stocks. And I rather make the fund manager do it because these guys manage hundreds of millions of dollars, if not billions. So the interest rate that they get, their borrowing interest rate is going to be much less than ours. Trust me. So the good news is that the management fees are still lower than mutual fund management fees. Those can go to 2%, 2.5% or more. So you could expect fees ranging from 0.55 to a little over 1% with the income style. Definitely higher than the growth guy that just gets an S&P 500 index fund like VOO or VFV. But still lower than mutual funds, which is what your financial institution will sell you or your bank will sell you. Also keep in mind that the dividends and distributions, or the passive income that you get, are all net of management fees. So management fees, guys, is not something that come out of your account. It's not something that you see come out of your pocket. It's all included and transparent. It's all within the fund itself. Con number 3 is potentially and probably lower total returns than the growth investor. So this is touches a bit at con number 1. So because of the covered call strategy, guys, that a lot of these income focused funds use, they are giving up share price potential, as we discussed earlier. Now, total return is really measured by dividends and the capital appreciation, or the stock price upside. So after a really long period of time, 10, 20, 30 years, let's say the total returns of the funds that use the income enhancing strategies will most likely lag the funds that don't, right? So this is because over time the stock market is projected to keep going up and up and up. Also, although we get more passive income, we might get a lower overall total return compared to the growth investor. So numbers wise, guys, it might be lower. The income strategy really shines more with the psychological benefits, in my opinion. And life is not all about numbers, but this is just my opinion. Of course, some people are just obsessed with numbers and rather get 2% more total return and be anxious all their lives instead of living a stress-free and worry-free life and make 2% less overall. So I personally rather sleep well every night, but hey, that's just me. Some people are just obsessed with the numbers. They're obsessed with management fees and things like that, which is completely fine. But that's just not how I see things. Okay, so what about the third style, the dividend growth style? I'll go through this quickly because I feel like this video is going to be like 4 hours. I would like to say that this strategy, the dividend or dividend growth, is really in the middle, kind of in the middle between growth and income. So it's obviously a dividend focused style, like the name says, but you also want to capture most of the overall rise in the stock market, as well as the growth of the dividends itself over time. So you could accomplish this really in 2 ways, kind of like the growth style. Really buy individual stocks, or stock pick dividend paying stocks and hold them for a really, really long time, or just purchase dividend themed ETFs that don't use a covered call strategy. So it's more of an organic ETF. So there's plenty of them out there, guys. And you could even do a combination of the two, right? Some funds and some single stocks. So what are the pros? Pros is really, like the growth strategy, it's a proven long-term strategy that works. So this is also a very popular strategy that has proven to be successful. The general premise behind it is that you hold dividend stocks long-term that tend to raise their dividends over time. So after years and decades, your overall portfolio yield or dividend yield is also increasing over time. Also, you are capturing a lot of the overall growth of the stock market as well, more than the income guy, because you're not using any cover call strategies. So your dividends are growing, but also your capital. So keep in mind that dividend paying stocks tend to grow a lot slower than dividend stocks, like tech stocks, for example, that provide no dividends, like Facebook, Apple, Tesla, etc., to name a few. Pro number 2, you will have a decent yield, probably of about 3 to 4%. So although most people that use this dividend strategy long term use the drip to reinvest all their dividends to really compound their growth or their capital appreciation, you do have the option of getting your dividends in cash. So if you're looking for a little bit of passive income, this could be a viable strategy, like the income focused investing strategy, although you will never get the same yield as the income guy, as the pure income investor like myself. So you will get about 3 to 4% yield, whereas the pure income investor typically gets at least 8. What about the cons for this dividend strategy? Well, the con number 1 is that you're highly dependent on dividend increases over time. So this strategy really works great if companies keep increasing their dividends, right? And history shows us that there are a few companies that just keep doing that. A lot of companies that just keep growing their dividends over time. They're typically referred to as dividend aristocrats. But keep in mind that dividend increases are not guaranteed. They are at the complete discretion of the company's board of directors, and nobody can predict the future. Nobody. Of course, we know that dividends are really profits from the company given out to us. So it doesn't, just because a company is really profitable now and doing amazing now, in 5 years it might, they might be a bit less profitable, so they might not be raising the dividends all that much later on. Con number two, dividend cuts are a concern. So dividend cuts can really sting a dividend growth investor really bad. This is because the style of investing highly depends on the dividends growing over time. It's your only source of income, unlike the income investor who has multiple sources of income, right? Dividends and covered call income or other income enhancing strategies. So although it's very rare, like I discussed already, that blue chip stocks cut dividends, it is possible. Think of Shell, think of Suncor in Canada, and AT&T in the US. Those are just a few examples. Con number three, dividends are not really tax efficient income. So although dividends are taxed better than interest income, that's the income that comes from bonds, government bonds, stuff like that, they are taxed worse than capital gains, which is what covered call income is, or when you buy low and sell high. So like I said, once again, I have 2 tax videos. Make sure to check it out if ever you want to know more about tax implications. So those guys are really the 3 styles of investing in my own words. Again, this is how I see them. The $1 million question now really is, which one is the best? The answer is none of them are. When it comes to investing, not speculating, there is no right or wrong, good or bad, in my opinion. All 3 options are good and can work just fine in the long run. The real question you should be asking yourself is, which one is best for me? So younger investors, typically they're attracted more to the growth style, and it makes sense because if the stock market just keeps going up and up and up long term, the younger you are, the more time in the market that you have. So your capital gains can really be enormous over 30, 40, 50 years of time. So older investors, on the other hand, like retirees or people who are about to retire, are typically more attracted to the income style, right? Because they don't really care about growing their net worth anymore. Their new priority, because they're retired, is maximizing their income. They need as much income as possible to sustain and enjoy their retirement as much as they can. The more disposable income they can, the more cruises they could go on, the more snowbirding they could do, vacations, etc., etc. So you don't have to be retired to choose the income style. However, we're in our mid-30s and that's the style we use. As you already well know, there's nothing we treasure more than financial independence, and income investing is simply the quickest way to get there. So for anybody who values passive income, financial independence above all else, income investing is also a great fit. Some people like to have a balanced approach and choose the dividend growth style, which is kind of in the middle. So I can't tell you which style is best for you. Only you can make that decision and figure it out. So once you choose your investing style, how do you get started for those of you who are watching and are newer to investors or complete beginners? So there's so much information out there, guys, so many ETFs and funds. Which one should you buy? This could be very daunting and scary for newer investors, but luckily you found my channel, so don't worry, I got you covered. So although this channel focuses exclusively on the income style, I am well aware of and well versed with the growth and dividend styles as well, and know how to build a portfolio for those strategies as well. This is why I created a digital product, which is available on my website, passiveincomeinvesting.ca. So although the name of the product sounds like it focuses on the income style, so the actual product is called the Ultimate Dividend Passive Income Investing Packages. The product is really all my years of research, hunting down all the best funds on the Canadian and the US stock market. So not only that, but the product has sample portfolios for both Canadians and Americans to help you get started. So I am currently working on version 3.0 of the product, which should be out in the next month or 2. And the biggest update I'm actually making are to the sample portfolio. So right now I only have 4 sample portfolios, 2 for Canada, 2 for Americans. One focuses on income and the other on a balanced approach. So there's not much there in terms of sample portfolios, but in version 3.0 that I'm working on, there will be 12 sample portfolios, 6 for Canadians, 6 for Americans. And I'll give you a really sneak peek here, a preview, because I know you guys love the sample portfolios and I'm really excited about this. So here are the 6 themed sample portfolios I'm thinking of doing in version 3.0. Number 1, income. Number 2, growth. Number 3, dividend growth. Number 4, balanced. Number 5, aggressive income. Number 6, aggressive growth. So 6 portfolios instead of 2. Of course, you can, mix and match, combine different styles as well. The possibilities are pretty much endless, guys. So I know many of you watching have already bought the product, but for those of you who haven't, I strongly suggest you pick it up. The link to my website is in the video description below, and I have also a video where I show what the product is in detail. It's basically spreadsheets, right? So make sure to check out that video so you will actually see what you're about to purchase before purchasing it. What's also cool is that it comes with lifetime updates, so you only need to buy it once in case a new version comes out. And another good thing, it's very cheap. It's only $45. 45 Canadian dollars, by the way. So I have received a lot of positive feedback from you guys about this product. I really appreciate it. If you purchased it, please make sure to leave a review on my website if you haven't done so. We have about 130 reviews, and 90% of them, or almost 90%, are 5-star reviews, and these are all legit and real reviews, by the way. So thanks, guys, for those of you who already left a review, and if you haven't, please go ahead and leave me a review. I'd really appreciate it. As always, please support me in this channel by hitting that like button. I would really appreciate it. It's free for you. It's a win-win because it helps the channel grow. Also, make sure to visit our website, like I mentioned, passiveincomeinvesting.ca, where you could pick up my digital product. Also on my website, I do offer a consultation service, a one-on-one video consultation service. However, I am completely sold out until October, so I'll let you guys know when my October appointments open up. And finally, guys, make sure you're subscribed to my channel if you haven't already done so you don't miss out on my future content on passive income investing and on my future community posts as well, surveys of the month, etc. Also, if you use social media, we're on Instagram, we're on Facebook. Join us there. We have a Facebook group with over 2,200 members now, so we have a nice little community there. All the information is in the video description below. My mission, the mission of this channel, will always remain the same, guys. It's to help everyday, regular working people to invest on their own in order to build their own stream of passive income to enhance their quality of life. So with that, take care, guys. Stay safe. Please make sure to get that second dose, and see you next time.